I've got this. Does
No,
this?
that doesn't work.
Oh, that doesn't work. Oh, okay. Sorry.
Hang on. You want this or do you want the mic?
I'd rather do that, I think.
All right,
Yep.
just give me a second.
Okay.
Give us 1 second. I'm going to turn this off. You clip it on and then just turn it back on.
Okay.
How many of you guys would like to buy your first rental in the next 3 months? That's a lot. Good. So we've covered so many.
How about another rental in the next
Another rental in the next 3 weeks. That's it, right? So we've covered a lot of advanced topics. Yesterday, you agreed. I mean, very hard. You made our heads explode. Wendy, all the self-directed IRAs, Coupon with all the notes, right? So let's get real and let's get simple for a little while. So I want something for every person in this room. So if you're thinking a lot of this stuff makes your head explode and you're not sure how to roll, this session is for you. You're going to know how to roll exactly the steps to take after this.
Yep. Okay. Thanks, Jim.
Thank you.
So first of all, just kind of a 30-second deal on my head. Oh, is it not on? What do I have to do?
You got to flip the switch
Where's the switch?
right here. Try it again.
Okay. Yay. Okay, I can hear that. Thank you. All right, so like a 30-second deal about my head. What's up with my hairstyle? So in 2007, I developed alopecia. So alopecia is a thing where your autoimmune system thinks that hair is bad, but then it's like, but don't worry, I got this. We're going to get rid of all of it. So that's what my immune system did for me. And so now, 13 years later, I decided, over the course of the years, I wore wigs for a while, and then about 5 years ago, I decided to do the tattoo. And I worked with Amy Black here in Richmond. She's an amazing tattoo artist. And so I actually have a website about my head. It's called BlueLotusHeadTattoo.com because I do run into a lot of people who want to understand a little bit more about it, so I put a lot of stuff on there. So anyway, that's just kind of the fun thing about my head. So on my real estate journey, it's kind of interesting that I started, my first rental I bought back in 1997. I was very close to my personal property that I just bought, so I really didn't know what I was doing. I wasn't sure, like I didn't know if the mortgage payments were deductible. Like I really didn't understand it exactly. I just knew that there was a cheap house down the street that I could get. So I bought that house, and then I had a tenant. That tenant stayed a number of years, which was really fortunate, worked out well. And about 2 years after, somewhere a couple years into when her being a tenant, she came over to my house one evening, and she had this bag with her, and she said, I have this stuff. She said, I got it. I don't know if I'm really going to use it, but maybe you will. And so I opened it up, and it was a cassette tapes of Rich Dad, Poor Dad. So there's so many people, so many investors who talk about, you know, the impact that Rich Dad, Poor Dad had on them and how it helped them get started. I feel like I may be the only person who learned about Rich Dad, Poor Dad from their tenant. So I might have had it a little backwards, but. All right, so as Jim said, what I'm going to talk about today is the financing aspects of the BRRRR strategy. So I know that a lot of you are, you've been listening to a lot of these presentations, and it's like, oh my gosh, here's another talk about financing. Like, when do we get to talk about the fun stuff? And I'll tell you, the financing gets you to the fun stuff. One of the things when I really started getting serious about real estate education for myself, one of the things I heard somebody say was, if you want to be really successful in real estate, you need to understand financing. And I thought, oh, really? Like, isn't there another way? Like it just seems kind of intimidating. There's all these terms and jargon, and I'm a reasonably smart person, but there was a lot about it that just felt like foreign language to me. So I'm going to try to help break down some of that terminology for you. But I will say that absolutely that point of understanding your financing and your financing options is truly a major key in being successful in real estate. So I mentioned here too, one other thing. So I mentioned here on the slide, I'm with eXp Realty. I'm a realtor. How many other realtors are here? Wow, that's a lot. So look around, keep your hands raised. look around, these are your realtors. So if you're not working with a realtor who's getting this kind of education, maybe you should think about that. You know, this is an important understanding. Having people on your team who understand how this all works and what you're trying to do can be very, very beneficial for your success. So let's jump in. So talking about BRRRR strategy. So this is a thing that people have been doing for decades, but it just kind of got this name, this acronym BRRRR in the past few years with the Bigger Pockets guys. So what that stands for is you're going to buy a property, rehab it, rent it, so you get your tenant in place. Then you refinance, which is a piece we're going to talk about more today. And then you repeat. You do that over again. So this is what Michael was explaining, how you can get things moving, how you get from 0 to those 4 or 8. This is a process that many, many people have used successfully, even before we had a name for it. And so this is something that you should really consider using. There's other ways to do it, but this is one for sure. Now, I've put a little R on the front of that. I would add another R to it, which I'll get to explaining in a little bit. I don't think that anybody else is going to be calling it that, but you'll see what I'm talking about in a minute. So let's start with the financing aspects of your first 2 phases, right? You're going to buy and rehab. So in order to do that, you have to have money from somewhere. Now, in the BRRRR strategy, we're leading up to being able to refinance. So the idea is that this initial money that you're getting here is short-term money. Something, a transactional funding for just a month or so to be able to purchase, or going all the way up to 6 or 12 months during the initial period that you're holding the property. But this is your funding for buying and rehabbing. You may have your own cash to do this with. You could be using that home equity line of credit that belongs to you. There's also commercial lines of credit that you can have access to do this, to get started. Private money lenders, hard money lenders, these are all ways to get that initial funding. Now, that's not to say that you couldn't also just buy with a loan from the very beginning. Which is also possible, and we'll talk about some of those types of products, those loan products that are available. However, this is really more suited for the type of market we're in right now, where pretty much to get a deal, you need to be either all cash or as close to cash as you can get. So these initial funding sources are the ones that get you close to being an all cash type offer rather than a financed offer. So then after you've got that funding, you've done your work, now you get a lease. So you have proof that, okay, I have this rented, I have it rented at this rate, so I have a projected income and cash flow from the property. And now you're going to go to a different funding source to get long-term funding. Long-term funding may be as long as 30 years, it may be 5 years, but this is your more permanent long-term funding that you then use that money to pay off your initial lender, and now you're ready to repeat, go again. So what's the part of this that I think that I want to add into the mix? This is the typical traditional BRRRR. What I want to focus on and what I want to talk about right here in with this presentation is this first part. That's the part, the other R, the research that Michael referred to. You do have to do before you're moving into that first initial buy. But what I want to say is part of your research absolutely needs to be investigating what your refinance options are going to be. Okay, so this is not just in theory, oh, my buddy said that, Union Bank is doing this, or, some other option. This is you, for your situation, your credit situation, your employment situation. This is what are you actually going to be able to rely on when you go to refinance. Okay, so that research is really, really critical. And then I would also add that to this step, because this might be a year later. So a year down the road, when you're getting ready to repeat, you need to repeat this process as well. You need to see, again, things have changed. Your income situation has changed, the banks have changed, your lender's options may have changed, so you want to do it again. So what I'm going to be working toward with the slides I'm going to show you is what we're building toward is increasing your knowledge of what you can do when you're doing this step, when you're doing this investigation. You're getting on the phone, you're calling different lenders, you're asking them questions, you're trying to understand what your options are. So what I want to do just in the next little bit here is help you understand what those questions are, what they mean, and why they're important to you. Okay? So let's start with the, again, kind of going through that process, but again, more specific to how the money's going to work. So the first thing you're going to do is when you buy the property, right? So you buy the property, you have some closing costs. This is your day zero when you've purchased the property. This is using that initial short-term money that you've found. So now, and then now, a little bit of time goes by, you're doing the rehab work, right? This could be, depending on if it's a big rehab, small, could be a couple of weeks, it could be a couple of months, but that's the additional work you're doing, so now you're still, adding into using the money that you have access to. And during this time, you may also have other costs. That could be, you could consider that to be your interest payment on your short-term money. Whether you are paying that as you go or paying it at the end, it's still money you will have to pay out. So this is going to be part of the cost of getting into the house. You're also having to keep utilities on. You may have to mow the lawn. There's different costs that occur during the time that you're holding the property. But at some point, you're like, okay, I'm done. This is it. I'm ready. So that's your all-in cost. Right, at that point in time. This is your full cost of buying the property. So now that you've done the work, you've rehabbed it, so now you have some idea of the appraised value. So when we're talking about an ARV, an after repair value for your rental properties, when you're thinking about it, it's really what you're anticipating is what is it going to appraise for lending purposes. You don't need an ARV because you're going to go sell it like you would do when we talk about flipping a house, but you do need to be very, very aware of what do you think the house is going to appraise for, because this is going to be critical for your refinancing. So you've got some kind of appraised value here that you've created, that exists, and you want to be kind of conservative on that number. This is not the appraisal that you can like top out max dollar. This is a conservative idea of what the home value is. So between your all-in cost and this appraised value, that's your equity. So that's what we're describing when we talk about equity. That's what we mean. It's the difference between what it's cost you to be in the property and what the house is worth. Again, we're doing a conservative appraisal, but it's still that sense that's your equity. So now you say, okay, great, I'm done. I got my, now we also have it rented, so now I'm ready to go talk to a lender about getting my loan. So you're ready, you're like, I'm ready, I want my money now. So you go and you talk to your lovely banker, and what they tell you is, of course, we would love to lend you money on this property. We will give you all of 80% of what it cost you to buy the property. Okay? That may very well be the answer you would get if you just picked up the phone, the day after you finished your rehab, you've just signed your lease, and you're thinking, like, this is the amount of money I want to cover, but this is all they're going to give me. So that's not going to work, okay? So then what you find out, hopefully you're not just finding this out now, but some people do. What you then find out is actually that banks have something they call a seasoning period, okay? So banks, lenders, mortgage brokers, different sources of funds may have something, a seasoning period where they say, we need to wait a certain amount of time before we're going to give you your money, before we're going to do a loan for you. It could be 6 months, it could be 12 months, but that's what they call it. So during that time, now you've done this already, right? Your purchase, your closing, your rehab, you did all that. Now your other costs are going to be even a little bit higher, right? Because now you're having to hold it longer before you can refi out. So now you're thinking of what your all-in costs are, might be a little different. Of course, the good news is during that time you're getting rent, right? So you have the rental income, but there's still a longer period of time where you're paying your initial lender, and that may be at a higher, probably is going to be at a higher interest rate than what your long-term funding is going to be. So there is some real, permanent increase in the cost that you had to incur to get into the house. So you've still got your appraised value. You've still got equity, maybe just a little bit less now because of the length of time that you had to hold it. So now when you're ready to go get your new loan, again, depending on what lender you're working with and what their rules are, what they're willing to pay, this is what you're trying to find out now is, okay, what can I get? How much money are you going to give me on this lovely property that I have? So a lot of times, very common, what you may run into is that the lender would say, okay, we will give you we're willing to lend 75% of the appraised value. Okay, that could be their statement. And so of course that means there's 25% of the appraised value they're not going to lend you. So your new loan now is going to be somewhere in that range. So the goal is that it's at least above what your all-in cost was, right? So this is what Jim and Michael were saying to be cautious of, right? Just because this is this amount is over what you needed to repay yourself, like don't go crazy with that. Right? This is where you don't go buy your jet ski with that difference. This is for your property. So maybe that little bit, if you think you could get a little bit, dip into your equity a bit, maybe that helps you have some reserves, which is good. But again, got to be cautious. You want to be conservative. You don't want to count on that, but that could be something you could use. So now you're set for being able to repay, because now you've covered all your costs, you can repay your lender. So that's your refinance process. And so this is another term that you want to know for sure. This is your loan to value. So this is what they mean when you hear people say LTV, loan to value. This is what they're talking about. How much will they lend you as a percentage of the value of the home? That's your LTV. So let's talk a little bit about lenders. Who are the people that you might be talking with, especially if this is your first, second, third rental property that you're trying to buy? Who are these folks you're going to be talking to? So some of the critical things that we want to consider in the folks that we're going to talk to, first of all, what kind of guidelines do they have to follow? Is there certain rules or regulations that they have to worry about or that they're going to apply to how they look at lending to you? What are they willing to do in terms of how you own the home? Do you have to own it in your own name? Can you own it in an LLC? What are their common loan products? What does it take to qualify for one of their loans? What's that going to look like for you? And in that qualifying process, what are the critical numbers that they're going to be looking at to assess your situation? And again, how much they're willing to lend you, and again, the seasoning that we talked about. So the first one we would think of, a lot of folks, they're right to the national banks, right? The Wells Fargo, SunTrust, Bank of America. Those are the folks who they may call because that's who you know. Maybe that's who you have your accounts with. And that can certainly be an option for you. This is where we were talking about these guys, for these conventional mortgages, they're subject to what we call the Fannie Freddie guidelines. And the reason is that these banks almost never keep the loans in-house. They're going to be reselling the loan. So in order to resell the loan, they have to guarantee that loan is conforming to those guidelines. So they're not setting the rules. They're saying, as long as I follow these rules that were outlined by these programs, then I'll be able to resell the loan. So this is where you get the things like the 10 max. And actually, it's the first 4 kind of follow under one set of rules, and then it gets a little tougher for 6 through 10. And that does include if you have a loan on your personal property as well. So this is only if it's in your personal name. And so that means it's going to depend on your personal credit. So they'll be looking at things like your personal credit score, what's your debt to income ratio. This is your personal debts and expenses. That's credit cards, student loans, what do you pay for rent, what do you pay for your own mortgage, that kind of thing. They're going to look at that. And that's a 6-month seasoning period. So for some folks that could work, that could be fine. A lot of times you may want to look for other options as well. So the next set of folks to talk to are what we would call portfolio lenders, or something outside of that. It's still banks, bankers, mortgage bankers, but it's not the top, national banks. These are the local banks. I heard somebody once describe it as the banks you've never heard of are probably your local banks. So in our area here, Atlantic Union, Town Bank, those guys, those are our, some of our local banks. Credit unions would often do these kinds of loans. So they will do, a lot of times you will find that some of them will do both individual lending and commercial lending. They may have both sides. It might not necessarily be the same person at the bank. It could be an entirely different department, but within that company, institution, whatever, they handle both types of products. So usually they'll make up their own rules because they're keeping their loans in-house. When they agree to loan you a certain amount of money, then that loan, they're gonna keep it. That's part of their loan portfolio. So that's what we mean when we say a portfolio lender. I used to think, like when I heard that term portfolio lender, I thought it meant like they were gonna loan on my rental portfolio. And I was kind of confused by that because I was like, well, I've only got like one house. That's not really a portfolio, But what it means is they are keeping a portfolio of loans in-house. So they can make up their own rules. That may work for you. It may work against you. It doesn't mean that it's going to be necessarily better than the Fannie Freddie guidelines. It just means that they are going to make them up for themselves. That also means they're going to be different from company to company, bank to bank. The credit union, this bank, that mortgage broker could all have different sorts of rules because they get to set their own. So that's why you're making these different phone calls to these different lenders. So on the products that you could have available, it's going to be different depending on your personal name versus you buying in an LLC. Some of these, as time has gone by, a lot of these products are getting to be more and more similar, so that you do have the opportunity now, even if you own in an LLC, to get a fixed interest, longer term loan. That hasn't always been as accessible as a borrower owning in an LLC, but those are available. It's still pretty typical that a lot of commercial loans will be a 5-year with a balloon, and I'll show you a little bit more in a bit about what does that really mean, what does that look like. When you're buying in your personal name, those fixed interest loans, 15-year, 30-year fixed interest loans, that's going to be probably your best interest rate that you're going to have access to. And you may also have the opportunity for some type of renovation loan. But again, if this is a refinance, you've already done the renovation, so that's really not as critical to you. This is where you really want to understand the difference between, one of the reasons you really want to understand the difference between owning in your personal name versus an LLC. Because when you own in your personal name, now you're relying on your personal credit. Okay, whereas when you're owning an LLC, you're going down the commercial route, then the primary interest is in the collateral. What does the property look like? But there is an aspect to this that there are going to look still at your personal credit, because this is going to be a recourse loan, most likely, meaning that you still sign a personal guarantee. So there is an aspect of this that you're standing behind your ability to pay. You're relying on the income and the income producing nature of the asset, but it's not 100% on that. There's still, you got to stand behind it as with a decent credit. So some of the numbers that you want to, these folks will be looking at. The loan to value is, again, how much they're going to be willing to lend on the property. It's the personal credit is on your personal side. On the LLC commercial side, this debt coverage ratio is a very critical number, and I'll show you. I have a slide on that to show you more breakdown of what the debt coverage ratio is. And then the seasoning can really vary by lender. So depending on how, how experienced you are, how much, if you have multiple loans with the same institutional lender, it's possible that it could even be zero seasoning. I've seen that before. I've had that experience of being able to get a commercial loan, immediately after having the property in place. But that doesn't mean that that's going to be applicable to everyone. And finally, let's don't forget about our private money lenders, right? So there is the option for private money for long-term loan. And this, again, just all the way up and down the board varies by lender, because that could be, talk about people making up their own rules. Like, this is what private money lenders do, right? So you just have to have that conversation, but approach it the same way. Again, remember, we're talking about you need to learn what are your options for refinancing. So you have a conversation with Town Bank just the same way you have a conversation with, Betsy, who's a private money lender. You're finding out what your options are. Okay, so the next thing I want to talk about is your ownership options. So I said we were going to kind of break down some of those important points, aspects of what has a big impact on your refinancing option. A huge one is, how do you own the property? So this is where we get into the question of LLC versus owning it in your own name. So let me talk for a second about what happens if you own real estate in your own name, which you can absolutely do. Your first, second, third, fifth rental property you can own in your own name. So first of all, realize you're starting out, you already own something, right? You may own a home, you may have some bank savings, stocks, whatever. You've got some assets, you probably have a car. Those are assets that you own in your own name. So when you buy rental property in your own name, you're just adding to that bucket, right? It's just one more thing that you own in your own name. Now with all of these assets, you have different types of insurance policies, right? You've got, even if you're renting, you should have renter's insurance. If there's anybody in here who's renting that doesn't have renter's insurance, that should be one of your takeaways. You have to have the renter's insurance. So, but if you own a home, if you own a car, and now with your rental property, you have separate insurance policies related to each of those items, right? But if you're going to own a rental property in your own name, then you absolutely need to also add an umbrella policy. So this is another insurance policy that goes across all of these assets that gives you additional protection in case of any type of problem that happens that could be related to your rental property. But you don't, because you're mixing all these assets, if there is anybody who has who wants to sue you, which could be justified, maybe not justified, either way, they have the opportunity to go after all of these assets because they're all owned in your own name. Right? So that umbrella policy doesn't prevent the lawsuit from happening. It just helps to cover whatever final claim that might be agreed to. Okay? So that's when you own in your own name. So, all right, so now let's talk about the other situation. So now you've still got the same assets, right, owned in your own name, but what you're going to do is you're going to create an LLC. All right, so you create an LLC to hold other assets separate from what's in your own name. So that's what the LLCs do, is they add a layer of protection for your other assets. So you're not protecting, like having an LLC doesn't protect what's in the LLC. What it protects is all this other stuff. So if there's some kind of issue with what you own that occurs because of what you own in your LLC, that's what they're limited to going after. So let's say you own a couple of rental properties in one LLC, you've got your own individual insurance policies that have some liability, coverage there. But if there's an issue, a slip and fall, whatever, with one of these properties, the extent of what they could go after are the assets that are owned by that LLC. Yep.
Now, if you have an LLC that owns the property and you have an umbrella policy that covers you, does that also cover your LLC?
No. So what we recommend is that you have an umbrella policy for the LLC and an umbrella policy for your personal assets. Because the umbrella policy can only be written in the name of the asset ownership. So you can do this. So if you had, yeah, that's the answer to that question. Now, as an aside, one of the things that I've heard as a kind of general, guideline, rule of thumb, whatever, when you want to think about how many properties should you own in your LLC, it's not so much how many properties, it's how much equity. Because if this house is a $100,000 house and you have an $80,000 mortgage on it, how much equity is there? $20,000. Same thing over here, right? If you had both of these that way, then you've got a total of $40,000 at risk, because even if somebody got a judgment against you and was able to take the house, that doesn't wipe out the obligation for the mortgage. Okay, so the only thing that person gets is that $20,000 of equity. I mean, you wouldn't want to have to give that up, but that's a big difference if you owned both of these free and clear and they were each $100,000. Now you've got $200,000 in equity. So one of the guidelines that I heard was, say, roughly around $250,000 of equity in each LLC. So once you're getting up above that amount, but you can make up that number for yourself. Just realize what you're talking about is how much would you feel comfortable having at risk in the same bucket. Because at some point, if you have one LLC and 50 properties with $1 million of equity, again, remember, the LLC is not protecting what's in the LLC, it's just keeping separate what's over here. If you're driving a junker car and you're renting and you got $20 in your checking account, well, first of all, you probably don't have 50 houses, or else you're doing something wrong. But remember, it's about what are you trying to protect. So a lot of people want to make that decision about should I own in my personal name versus an LLC, strictly on the idea of what does it mean for liability. Liability is a crucial aspect of it, but remember, it also puts you on completely separate paths in terms of the type of financing you're going to be able to get. And that's what we're talking about today, is what are your financing options. So another aspect of this we want to talk about, I said on those commercial loans that they want to use the debt coverage ratio. So I'm going to just break that down for you real quick. What do we mean by debt coverage ratio? It's essentially just yeah. Colette?
Hey, sorry to take you back. When it comes to the commercial lenders, what is your experience with properties held in land trusts?
I have not yet gone down the land trust path, so I have heard that is possible. Does anybody here have experience with that to answer that question? Yeah, Lindy?
We don't do land trusts. We used to in the commercial world, and the reason we stopped doing them was because every land trust can be different. There's no uniform. An LLC is a uniform thing, entity. Land trusts can be so different that like 6 to 8 months ago, we had no more land trusts. And a lot of commercial lenders are going that direction.
Yeah, you and I can talk. And anybody that has that financial.
It depends on your bank. I have a bank at home that as long as their legal department reviews the trust and approves it, then they'll flow it straight through.
So I would say that what we're going to get to at the end of this, what we're working toward, remember, is our list of questions. So if you're going to own in a land trust, I have on my questions that has to do with like, how would you deal with this type of ownership? So you would absolutely make that one of your questions. And you might have to call, 5 banks instead of 2 to get there, or different kinds of lenders. So on the debt coverage ratio, it's the amount of money you have that's available to pay the mortgage divided by the amount of the mortgage, right? Because I'm talking here mostly banks, but that's pretty much it. Like the bank wants to know that you're going to have enough money after you've rented out this property, you're going to have enough money to pay them back, right? They don't really care if you cash flow or not. They just want to make sure they're going to get their money and that you have some cushion over that. So let's look at how this works out as a real example. So in the case of, let's say you have a house that's renting for $1,275 a month, and the taxes, insurance, maybe you have an HOA fee, something like that, work out to be $233 a month, then the net, this minus this, is equal to the available dollars. Now I show this on both a monthly and an annual level, and you can go either way. Because some of your bills, or some of the things that you could consider, like your taxes, you generally know your taxes are X amount per year, right? But if you start from that direction, whoops, sorry. If you start from that direction, you need to break it down into a monthly number or vice versa. So we're used to thinking of some things like rent more as monthly, take that up to annual. Annual expenses you want to take back, HOA if it's quarterly, whatever. You just need it in the same time frame. So this doesn't mean that this is every single type of expense that you might have. It just means that these are the typical expenses that the bank is going to subtract from your rent to determine your available amount that you have available to pay. So if you have, for example, a property where you're paying all the utilities, then those utilities, that may or may not be something that the lender is going to take into account. If you have a large expense that's different from just taxes, insurance, and HOA, then that would be another question. If you're going to try to get a commercial loan, you want to know, is that expense, did they include that in the amount that is subtracted from rent to come up with your available dollars? So now you've got some form of like your anticipated mortgage. This is what the amount of money, this is the loan you're expecting to try to get from this lender. And it's based on, in this example, we're talking about borrowing $105,000 at 5.5% amortized over 20 years. So that's our just starting point example here for this exercise. So that happens to be a mortgage payment of $722. So your debt coverage ratio is just the 1042 divided by 722, 1.33. So various institutions, banks, whatever, they're going to have their own criteria for what is a minimum debt coverage ratio. For a lot of them, it's 1.25, could be 1.2, could be 1.4, and that can vary over time as well. Like 1 year, 1.25 may look good. Remember I said they can make up their own rules. You know, maybe they start getting a little more nervous about the unemployment or the market or whatever. Maybe they're going to increase that minimum debt coverage ratio. That's why I said you want to repeat this process when you're ready to look for another property, because you want to know what are the rules that are going to be, what are you going to be having to have as options for your refinance. So this is all great as long as this works really well for experienced people that can show rental income on their tax returns for the past 2 years. There is a thing, and so for the folks that are really literally starting at, like, this is house number 1, something that you absolutely need to be aware of is that they probably won't count 100% of the rent toward your debt coverage ratio. So what's a likely amount, I call it disallowed, it could be considered vacancy. You're not literally thinking that your house is going to be vacant for 25% of the year. It's just a factor that is applied basically as like, hey, you're a newbie, so we're not sure, you know, how it's going to go. So therefore, we're just going to just take out 25%. So now that 1275 gets dropped to 956. So when you have the exact same taxes, insurance, the same expenses, but your available amount is much lower. So in this example, it's almost exactly the same amount as the mortgage payment, so it's only a 1.0. So that's not good, right? So the fact that you're a newer investor, just be aware that this is something you may have to work around. So what do you do in this situation? Do you just like throw up your hands and you're like, okay, sorry, well, I guess I can't deal with those guys? No. Let's look at another option. Let's look at another option for your loan. What if instead of doing a 20-year amortization, you did 30? Okay, so a 30-year loan, again, we're talking commercial, so this is probably in an LLC. Don't know exactly what the interest rates would be, but this is the point. The difference, if you were to go to a longer term, you're definitely going to have lower monthly payments. In this case, it drops the monthly payment to $577. So with a $577 mortgage payment, now your debt coverage ratio is back up to 1.25. Okay, so you can kind of mix and match. You're trying to anticipate, are you going to meet the minimum debt coverage ratio if you're buying in your LLC? That's a very, very critical thing to know before you try to buy the property, right? That's kind of the theme of all of this, is it makes them, the folks that talk about BRRRR, they make it sound really simple, right? You just buy it, you rehab it, you get a tenant in, and then you just refi, right? Well, make sure you're really going to be able to refi, right? That's the theme of this whole deal. All right, another one we want to talk about. So I want to explain a little more about these different types of loans, and especially on the balloon, how that works. So I've got some numbers here. They may not be exactly what today's interest rates are, but the more important thing is understanding the comparison of how the loans work, and a general idea of the impact of different ways of amortizing loans. So on the first one, we talk about a 30-year fixed loan. Let's just say, for example, the 30-year fixed that you own in your personal name. If it's a $100,000 loan at 5.5%, that's going to be a monthly payment of $568. So over the course of that 30 years, you will wind up paying a little over $200,000 in the payments that you're making for that mortgage. Okay, that's just the way it works out. If you're getting a longer term loan in an LLC, then there are products that let you have a full 30-year loan when you own it in an LLC. It's probably going to be at a higher interest rate. So this example, if you bump it up to 675, now you're out to $233,000. Also, your monthly cash flow is going to take a bit of a hit because you're having to make a higher monthly payment. But that is an option. So the one that I think is really interesting, and sometimes people don't get exactly how it works, is this 5-year loan, 5-year with a balloon. What is that? How does that work? So first you have to make some assumptions about what's going to happen 5 years from now, and 5 years after that, and 5 years after that. So in this case, the assumptions I've made is that you're starting at about 6.5%. And this is going to be built up with the assumption that at each 5-year period, it's going to go up at most another 1.5%. Now, is that guaranteed? No, we don't know. It could go down. But what's important to understand is the 5-year with a balloon is not an adjustable rate mortgage. Okay, an adjustable rate mortgage, the bank is giving you a commitment for your full 30 years. They're saying this is your loan. It's just every so often we're going to change the interest rate. That's not what this is. What this is saying is that we'll give you a 5-year loan. We're going to amortize it over, in this example, 20 years. So the monthly payment that you're making is pretending like it's going to be a full 20 years. Okay, so that's how we figure out what your monthly payment is. And at the end of that 5 years, there's now this $86,000 due. Okay, so now what happens? You're like, oh my gosh, do I have to pay them the $86,000? Possibly, but more likely what's going to happen is that amount becomes the beginning number for years 6 to 10. Okay, so now you've only got 15 years left. So your payment does go up a little bit, but it only goes up by $79. Again, this is assuming that the interest rate just went up 1.5%. So you keep going all the way out to year 20. And at the end of that time, with these assumptions, the total amount paid in interest is a little over $200,000. So it's not that different from this example up here of the full 30-year loan, but that's because we amortized everything over 20 years. So your monthly payments here were definitely higher than they would have been here. So part of your considering what type of loan you want to go for, what type of refinancing you want to do, depends on your targets for cash flow. If your main criteria, if your main importance at the beginning is really money, spending money, then you're going to be trying to go for a longer term. But if your goal is to get it paid down as fast as possible, then these faster amortization on the loan is going to be more beneficial. But again, this is how it works. So one of the questions you'll want to ask is, when you go to refinance, or not refinance, but when that 5 years is up and you want to carry it forward to the next 5 years, are there fees you have to pay? Are they going to want to reappraise the house? Is there something, like what happens at that point? It doesn't just sort of roll over magically. They probably want to get some more money out of you, and that might be different from one commercial lender to another. So that's something you also want to find out and take into consideration. So now we're into the final section on these questions. What are good? So on every table, there's a set of questions. You'll see there's a full sheet here. So I just made one copy. Should be, if there's not quite enough for everybody, I've got more I can give you later. But the idea is that you could take this and use it like a little worksheet if you want to call a variety of lenders to just put their name at the top. And okay, I talked to Town Bank on this day. I talked to Joe, and this is the information that I got. So first thing you want to do, first part of the conversation is you want to find out, is this lender are they a good fit for me? And I'll show you kind of what that looks like. Because you want to have, if there's any knockout questions, you don't need to go into a lot of detail. If you find out in the first 2 minutes that it's not a good fit, then you don't even need to go through all the rest of the questions. Then you want to start figuring out how much are you going to be able to borrow. That's important. And then what are the terms? What is it going to cost you? So I'm not going to go through every question here, but just the idea is is this lender a good fit for me? These are the knockout questions. Are you lending in Petersburg? No. Thank you very much. Right? What is your minimum loan, the minimum amount you'll lend? $75,000. I only want to borrow 60. My house is only going to be worth 80, so that's not going to work, right? So these are the knockout criteria. This is also I plan to buy in my own name, my LLC, my land trust. Are you the right person? Remember, I said in some banks or institutions, they may have a whole separate department for commercial versus personal. So if you're not talking to the right person, you could go down through a whole laundry list of questions and waste a lot of time. So just finding out, is this the right, do I really even need to carry this conversation further with you? Will you do a cash out refi? Some banks they're like, nope, we're done. We've done enough of that for a while. Maybe a couple of years from now we will again, but we're just not doing that now. Thank you, bye. Now you get into the questions about how much can I borrow. So these are the things we've already talked about. What types of loan products do you have? What's your maximum loan to value? This is going to give you an idea. By this point, you should already have some idea of what that assessed value was. What factors do you use? This is where you're getting into whether it's in your personal name or commercial. What's your requirements? If you use income, what do you want to see? Do you want my tax returns? Do you want my W-2, my pay stubs, whatever? Or if you don't have rental income, then this is where you want to be asking, what's the, what are your requirements there? And then now we're talking about, well, getting into the nitty gritty. What does the loan really look like? What are your interest rates? How long can I amortize this for? So what do most people think when they think I'm going to call a bank and ask for information about a loan? What are they going to ask?
What's your rate?
What's the interest rate? How many questions have we gone through already before we get down to what's your interest rate, right? There's a lot more to it than that. So remember when I went back to that first slide where I said under your research phase, you need to be figuring out what are your options for refinancing, okay? This is also, I would also direct this to the private money lenders. If you're going to be lending to someone who's planning on refinancing, do they know how they're going to refinance out? Or to borrow from Mr. Landlord, are they just hoping they're going to be able to refi, right? Or if you're going to jump into buying a rental and you're not even sure how you're going to refinance out, how do you even know if you want to buy it in your own name or an LLC, right? You need to investigate this before you buy. So this is part of the planning that you have to do in being ready to buy even your first rental. You need to know what's the whole thing going to look like. Begin with the end in mind, as Jim said. You've got to know what's your refinance piece going to look like. And that planning piece actually leads me to the very last slide, which is talking about, for myself, one of the things that I've done over the last year is I've developed a seminar. I call it Plan to Profit in Real Estate, and that's really an emphasis on planning, because I feel strongly that you have to be thinking ahead. So in the Plan to Profit seminar, we're doing it again in April. It's a 2-day seminar. Some people that are here have actually been to this. How many people came to some iteration of this in the past? Yay, thanks. Even Jack. Jack was in the very first, my guinea pig, where we went through 2 days worth of material in like 3 hours. So thank you, Jack, for that. So what we're going to do is the first day is all about rentals. It's analyzing, it's figuring out what is how are you going to finance it? Like this piece is very much a part of that presentation on the financing. How do you manage? Looking for them these days can be a little tough. So we talk about that. And then day 2 is kind of a whole supply chain of the money. So from both a borrower and a lender perspective, when you're talking about private money, we're going to talk about, for the flippers, how do you do a good funding proposal? What does that look like? And that's all the aspects of analyzing the rental, coming up with some rehab scope and costs so that you have a decent funding proposal. Then what's the private money process? What does that look like? And then ending with creating and using self-directed accounts for lending. So both from the borrower and lender perspective, how that all works and how it all ties together. So we do all that on the second day. And the presenters, I should mention before we get to the cost, so I'll be one of the presenters. Stephen Glover, who is here, he's from Peak Property Management. He'll be presenting on day 1. Lindy Pond from Finance of America will be expanding on this finance topic for us on day 1. And Pete DeWorkin, Fixer Upper Coach, will be there on day 2 to talk about some of the flipping piece of it. So the cost for both days is $149. I'm not doing this to make a ton of money. I'm doing this because I really feel like it is so important for people, especially people just starting out. But even us experienced investors can always, pick up a few tips here and there that can help you from stubbing your toe on something. So I really feel strongly that it's important to be educated, and I want to make that available. So I will also say, if you know somebody that you feel would really benefit from this, and if that 149 even is just a little beyond what they could do, talk to me. We could work out. If you come with them, we can, if we just cover their lunch or something, that'll be fine. But it's really a way, I feel, of helping people be successful. And also sometimes, because it is not all that expensive, I have to explain, this is not a teaser for some other, coaching or program or, this is not trying to get you into anything. This is really the whole thing. So just like what I presented here, that's what we do for 2 days in April. Thank you.
Where is it at?